All right, so we rebounded. We've rebounded to the upside. Is this the rebound? Like, are we still like, was that enough of a pullback? So I'm going to break down what I think the market will do early next week. What I think will, like how much longer this intermediate rally will last. I'll break down all of that from a technical perspective. We had some really interesting moves in the market, but not quite the moves that you would expect to see on a bullish day. I'll tell you what I mean and why. That three-headed monster we've been paying very close attention to. Two of those heads reared their heads, ugly heads. And why was that bullish today versus in the past? So we'll break that down. Taking a look at the sector rotation, the breadth doesn't look as good as we want to, but there's a nice little rebound in that. We'll break all the technicals down and like we always do, and give you a really good sense of where the market should be going here in the near term as well as in the intermediate term. We'll also take a look at our trade ideas, a stock that had been on a nice good bullish trend and has kind of had a nice good bounce today, much better than the market. And we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, September the 26th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment down there on anything that stood out to you today. You can join us at MarketScholars.com for free. Follow me, or you can email me at David at MarketScholars.com as well. Follow me on Twitter at DavidSettle42 for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're on our website, you can see if you go to Market Outlook at MarketScholars.com, you go to Market Outlook video archives, you can see all the blog posts that we post every day. These are free, and this is what it looks like. This is the Free Friday video, so you get the actual full version here, and our subscribers get the full version on theirs every day of the week, and the rest of the week our free subscribers get the preview here. But you can see a nice good summary of what happened in the markets and why it matters, everything that really matters to you here. So it's very educational piece. We try to explain everything and give you all the details that you need to know going into the next day and going forward along, like I said, with the video up here at the top. To get that, all you have to do is click on this. It'll take you to this page where you can click on join free and unlock this post. That brings you to this page. And if you click on this link in the top right corner, that also brings you to this page. And you just click for free. You join for free. And then when you go to the site, you just log in with your account. Right? You click on log in over here with your free account, and you get access to this post every day. And like I said, on Fridays, you get the full version for free. The rest of the week, you'll get the Market Outlook preview. And again, if you join our foundation tier, which is only $29 a month, you get access to, and it's $29 a month, which, like I said, is only $1.40 per video. You can cancel anytime, or you can get 2 months for free if you join for $299 a year, and you get 2 months for free there. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we rebounded today off of about 39 to almost 40 points there to the upside. So a pretty good rebound. The near-term line jumping up out of bearish territory, crossing 40, did not cross 50, came close, did not cross a second line. Like a lot of times when we want the near-term line to cross 40, it would be nice, because that means, again, that you're coming out of bearish territory. That 40th percentile represents kind of a distinction between bearish territory and neutral, and then 60th percentile is bullish territory and neutral. So in between, obviously, would be neutral. So when you're crossing out of neutral territory, it'd also be nice to cross again, or out of bearish territory, it'd be nice to cross into like either the upper half of the chart or into bullish territory. That's a good sign that things are, they have pretty strong short-term sentiment to the upside. And also, so like on this day, and so also you'd like to have the momentum line be higher, because the near-term line typically follows the momentum line. So you'd like it to be higher, and in this case it was. So we almost had that here again. So similar kind of bounce we had off of that low. I don't think necessarily though that this is gonna we're gonna go up the next few days like this. I think we still have maybe another down day or two in us. I think the near-term line probably gets back into bearish territory before it gets into bullish territory. I could be wrong, right? But that's my expectation. I don't quite think we're done with this near-term decline. This is a near-term decline, and if the near-term line does continue up on Monday into above 60th, then we're done, right? Then this would be the end of it. And then now it's a matter of how long the next near-term rally will last. And you can see the last near-term rally was a very, very long one. The one before that was not very long at all. It's like only 1, 2, 3, 4, 5 days. And then we had our near-term decline. So, and one before that was pretty decently long as well. So we'll see how much longer this one lasts. But I think that probably on Monday and Tuesday, and you'll see why here later in the video, but I think on Monday and Tuesday, we'll probably end up working our way a little bit closer below these lows, back into bearish territory, but not, oversold. So I'm not expecting the market to fall off a cliff, right? We don't live in this binary world that either the market's going up to the moon or it's going down 50%, right? It's, I do expect that, we'll probably get a little bit of a short-term decline still, work our way down towards 2%, because I think we only got down 1 1/3% at that point, and work our way down to the moving average and, either close below it like we did here on August 1st or test it like we did on the 21st and the 2nd on those near-term declines. So that would be my expectation, because again, you can see this would be the highest close above, like, because we got down to what, 1.28%. That would be the highest. The last near-term declines got a lot closer to the moving average. This one, we only got down to 2% above the moving average on that near-term low, and it was actually not really much of a near-term low. It was just kind of a sideways action, and then we had a good near-term rally off of that July 16th move. So it is, it's not as high, right? We've had higher, but it is higher than the recent precedent that we've seen, which in my opinion may suggest that if that is the low point, we probably don't last very long on the rally, would be my expectation. You can see the NASDAQ 100 looks very similar. It's not surprisingly, because they're pretty much the same index right now. The NASDAQ 100 did cross above 40 and 50, so it's a little different in that regard. And its market sentiment is actually below the 80th percentile, but the intermediate line is still above it, so we're still okay from that perspective. If I take a look at the Dow Jones, we barely crossed 40. So we did not get close to 50. The momentum line did come out. Remember, it was a little bit more oversold than what the Dow or the S&P was. We got that long upper shadow, and you can see the bounce there. And then finally, your Russell 2000 looks pretty similar. The near-term line did not get out of bearish territory. The momentum line is above it. You still have intermediate line barely above market sentiment. So it's a little bit of a bounce. But again, I don't think on any of these that the bounce is enough I don't think the near-term decline's done. I don't think we're on an intermediate decline where the intermediate line will eventually fall into bearish territory. I don't think we're on that mode. I think we'll have another near-term rally before that happens. So I'm not worried about that. But I don't think that this near-term decline's done, right? Because it's not done until we get back above 60 and we start a new bullish rally. Let's take a look at the weekly version. And you can see, it was kind of a little bit of a doji pattern this week. I mean, it looks like a Hakinashi candle, but it's actually the regular candle. So it's a pretty small range, only 130 points. It is, 92nd percentile above the moving average. So we're still pretty far up above for the third straight week. The momentum line is down, but not oversold. The near-term line's down, but still easily above in the upper reversal zone. So I think we're still okay there on the weekly chart. If I take a look at like the whole weekly chart, we still don't have the red line on the hull. So on the 20-week hull, we're still okay there. We're actually trading at 660. We're still trading a point above the 20-week hull at 661. The Hakinashi close is at 661.44. So we closed, 0.4 of a point above that. So just barely. And you can see that, we're flirting with that 5% level again on the PPO above the 200-week hull. So a 5% drop on the index could get us down to the 200-week hull. That's obviously moving higher, so it might be a little bit below it. And then we'll see if like this right here, if we get below it and then bounce right back above it, we're fine. But if we get below it and stay below it, then we're not fine, right? We're in correction mode at that point. Because the intermediate declines don't get below the 200-week hull. The corrections do. So that's something to keep an eye on, because we're not very far. Like, this is definitely not very far above the 200-week hull. So we are susceptible to a pullback that could be worse, right? I don't think that's the case, but we are susceptible based off of that pattern. We need to really kind of extend away from more than 5% above the 200-week hold, so we don't have that issue like we did last year. Again, you can see the Haginashi candle. Again, like I said, we closed a couple points above it, just for 66.43. Higher Haginashi close. We closed just slightly above it, higher high. So there's a it's like the open's gonna be at 66.01. The Haginashi close when we start on Monday will be at right around 66.43, depending upon any gaps. So it's going to be a small body. The body's already lower than the 3-week average. This week's body's already low. It's going to be smaller next week, at least to start, and then we'll see what ends up happening during the week. But again, I still think that even though we didn't close the lower close or close below the Haginashi close, we were very close to both. And so I think we are still susceptible for a transition candle next week, a candle like this, that if it is bearish, it would be a reversal. And if we did close below, like right now, 64.75 is where the 10-week exponential moving average is going to be. It's obviously going to be higher next week. We went from I can't see the number, but right around, maybe it'll be maybe at 65.20 or so next week. So it'd be a pretty significant drop to get a red arrow, but we would be susceptible to that, right? And even the parabolic SAR on the weekly chart, the parabolic SAR here was at what was that, 646.20. So that's going to move up. So we were at 641, and so we'll probably move up about 5 points or so into the 650 range. And again, it'll take a significant drop, but it's a significant drop next week. That would look like a transition candle. That if it was an actual bearish candle, like a gap up, maybe in a pretty decent sized body to the downside, and we flip that parabolic SAR, we get the red arrow. I mean, that's all something to keep an eye on. I think it's low probability, but those signals are what signal the beginning of an intermediate decline. So I don't think we're starting one, but that's what we'd be watching for next week to see if it actually happens. From a 3 green arrow standpoint, you can see we have 1 red arrow, almost 2. Again, near-term declines get you 2 red arrows, as we've seen here. So we're pretty close to that. Pretty decent average there, average volume. And you can see they're all that way, right? All of them are at either 1 or 2 red arrows. So they're all near-term declines. Intermediate declines, 3 red arrows, right? That turns into 3 red arrows in a red line. So, if you have 2 red arrows, your near-term decline. Your near-term decline could get to the point where you have the 3rd red arrow, and then we bounce. And then if we don't bounce, then we know we're on intermediate decline mode at that point. So that's kind of what we're seeing there. If I take a look here at, let's see here, the 2-line version of that chart, we're obviously well above all these moving averages. So we're all fine. We're back above the 8-day, in fact. So we're still fine, but the MACD and stochastic are still below their moving averages. The histogram's still actually getting bigger to the downside slightly. So again, I don't think we're done quite yet. The DMI, you can see we're back above, we're almost above 30 on the positive, but at least they're both moving back in the right direction. Your ADX has fallen back below 25, representing a slowdown in the trend. You're still really bullish, like you're still above, you jump back above 60 on the RSI, and you're back above 0 on the CCI. So both of them at bullish levels, not the strongest bullish levels, but they're still at bullish levels. The Ichimoku cloud, we still have a very mature trend. We have pulled back off of 20, so we're not threatening. The highest we got to was 19.5. So then we pulled back. So we're not threatening with that 20 level yet, but still, we're back above the 9-day midpoint, still have a very strong rate of change, still have a very green, so still a very mature trend right now. And then if I look at the Bollinger Bands, you can see we are in the upper half of the bandwidth still, and that's really important that we stay in the upper half of the bandwidth, or even if we just dip a little bit below it like we did these 2 times here, that we get like right back up above it, right? That's usually when you get the 3 red arrow signal as well. You can see the momentum is still good. The bands are still outside the Keltner channel, so everything is still okay there. We finished up the week with a higher high and a higher low, and we closed above the high. So that's a good sign for the markets. If we can follow that up on Monday and Tuesday, then we're good, right? We're good. We're done with this near-term decline, like I said. Kind of really keep a close eye on Monday to see how we do, especially compared to that 660 point of control, and if we start flirting back down towards 650 or not. Because remember, 650 or so, this is where that parabolic SAR is going to end up being next week. We look at let's see here, the range and the volume. The range was at below average, 4.5 points. You can see the volume down there at 69 million. So when you compare those to their normalized version, we're still below the 0.8% mark on the normalized ATR. The volume is still rising, which is crazy for an index that is also rising. But again, goes to show how strong the money flow has been. It's been at bullish levels. Again, we're not anywhere close, and we're well above this peak right now in the volume, but the money flow is not. And you can, at least we're still at bullish levels on the index, this oscillator down here that turns this into an oscillator. So we're still okay, but it's still, it's showing relatively strong and bullish money flow. It's just not confirming the price with the new highs that we've been getting. And then finally, let's take a look at the VIX. As I told you, we've had the trifecta on the VIX, right? The positive correlation with the S&P, the weak positive correlation with the VVIX, just the fact that we're down here below 15 and we're below us 0.85%, and the seasonality of the VIX as well. This is a pretty big drop that we had today in volatility. The VVIX dropped down to 93 as well. So we really kind of, that was a significant drop, and that could mean, again, that we're done with this near-term level. It could mean also, too, that's probably a little bit too much of a drop in one day, and that we might get a little bit of a bounce up, which, again, like I said, might suggest that we might have another day or two of softness. So we might not be done with this near-term decline quite yet, and this would be another reason why. All right, now let's take a look at what's driving this price action here today. So let's look at an asset class comparison chart. And we'll just look at today first, and then we'll kind of break down the week that was. But here's today. So this is the rebound that we had in the market today. You can see real estate led the way higher, which is not typical on a bullish day. Small caps, that's not bad. Equities, you can see gold outpaced stocks for most of the day. In fact, gold and real estate outpaced stocks for most of the day. Eventually, gold ended up coming down and matching the S&P. So again, not your typical. Commodities and yields were both higher, but the dollar was down, so that helped. Again, remember you got your three-headed monster. Commodities and yields are the two of them, and then the dollar would be the third one. So you have to have all three, because as you just saw, you might have commodities and yields moving up higher because of strong economic growth expectations, but a weak dollar lifts risk appetite, and so it's really good because if the dollar goes up with those two, then now we have inflation concerns, and so we have issues there. So it hasn't been a positive thing lately, but today we had a pretty good day. Let's zoom out to the week that was. Let's see, was it 22nd? Yeah. So the 22nd, and you can see, okay, look at commodities and gold, just big outliers to the upside this week. The dollar was up again at over 0.5%, despite a little weakness on Friday. Commodities down, again, but up a little bit on Friday, but not up very much. And then you can see the yields, the bonds ended up the week down. So let's take a look at those three charts. Let's first take a look at yields and how they're moving. Again, they have a limit. I think they have a limit. If they break this limit to the upside, then we're in trouble in terms of inflation expectations and Fed rate cut hopes. And I think the Fed taking rate cuts off the table for next year is very bullish. But they've priced in. They've said they're going to cut the end of this year. It's just a couple of cuts. It's very transparent. The odds are very high. I think if October and or December's cut comes off the table, then I think the markets are not going to do very well with that. And obviously that would mean yields are moving up significantly higher, and I think the markets would struggle really, really big time with that. And that's kind of what we're at. So there's a limit, and we're about at the limit. It can go a little bit higher up to that 4.25% range, because this is the the range that the Fed funds rate is. It's going to be hard for the Fed to cut too much if the 10-year is not cooperating. And so that's it's okay. Take 2026 cuts off the table, but don't take October and December cuts off the table. We can handle we can handle 2 more cuts and be fine, still be bullish. It's the indefinite cuts is what we don't want. We don't want cuts next January or March and into next year. We want it to stop after this year, like last year, like 2024. That's the most bullish scenario. It's just a couple of cuts and the yields rise, right? We want yields to rise. And the problem is, unlike last year where we were, almost 200 basis points below the Fed funds rate when they started to cut rates, and that's why it could rise so much, we're not that far. By the time we made the one cut, we were 25 basis points below the Fed funds range. So we got the one cut, and just like that, they're right back to even. See, we never really got back to even. Well, I guess we did over here. We got back to even to the 4.25%, 4.5% range here at the end of the year. We got back to that range. Well, we're already there, right? We're already there before they even cut the second time. So there's not as much room for it to go up. So I think there is some limit there. And with that move higher limited, I think it also limits the dollar's move higher too. Though the dollar is above the 50-day, and there's a chance that it can move higher and fill in that gap, and that would not be bullish for equities, as we've seen for most of this week when we had when the dollar was moving higher. And then finally, commodities are also moving higher right now, a little bit of a long upper shadow, but still above moving averages, and MACD and stochastics are bullish, and they are moving. That's not necessarily, it is something we don't mind seeing if it's, as long as the dollar is weak, right? But if commodities and the dollar move up together, as we saw in 2022 and since then, that's two heads of the 3-headed monster, and that's not 2 heads that we want to see working well together, right? We want there to be inverse relationship between the two, because that's more normal. So that's how commodities are performing. So that's, again, like I said, that's your, those are the really most important relationships, especially yields, that are driving the market. If you take a look at like the breadth improved a little bit on Friday. So it wasn't, we had hit -50 on the McClellan oscillator. On Thursday, we bounced back up to -26. So at least we're back above the -35 threshold, which is kind of a trending threshold, either to the downside or to the upside when you're rebounding. But we are clearly below 500 now, and if you take a look at like where the lowest level here was 401, 401. So we're at 426. So we're not quite to the lowest level, but another couple of days like this next week, and now we have the lowest summation index. We're coming off of a lower high and going down to a lower low, while the index itself is at clearly higher highs. So significant divergence that usually doesn't play out very well when we get these divergences like this, especially when they get in below 500 in between those 2 highs. So something to keep an eye on there. Let's take a look at some of these other oscillators. Let's pull up the ratio chart, or the number of stocks above the 50-day moving average, which had also really dropped significantly on Friday, rebounding back up to 280. So we are flirting with breaking below the 50% mark. We rebounded back up. So we're not. But we're not back above 300, nor are we back above the moving average. So again, like I said, don't think we're done yet. The new highs jumped back up to 81 from 40. So that's a little, but clearly well below. So again, that's a pretty significant sign of weakness for the market as well. The number of stocks above the 200-day are still doing okay, still above 300. You get below 300, and that's a sign of weakness. We are below the moving average, so that is, again, like we're not done here. The number of stocks with bullish profiles on their point and figure charts, which is what this bullish percent index looks at, it's also still pretty weak. It had really broken down Thursday, rebounding, but still well below its average. Again, this is not the most bullish sign either, right? We want to be above the average, not below it. And the average itself is at that important 60% mark, where bullish territory is. And you can see when we were really bullish over here, we got above 60 and we stayed above it. Here's 60 right here. So we stayed above it for a long time when we were bullish. Then we had some weakness, we broke down, then we barely got above 60 during this latest leg higher, and then now, again, back down below it again. At least we haven't got to lower lows, so that's a good sign, but we need to kind of get back above that 60 level there, and we're still not above that threshold yet. Let's take a look at some of the ratio charts that are, that we pay close attention to. This ratio, which is typically positively correlated, right now is negatively correlated. So it will return back to positive because it always does. And when it does, so that means both indexes, the S&P and this ratio will both start moving in the same direction again. So will they start both moving higher? Because there is some room for this ratio to move up higher. Or will they both start moving lower? Like, will this ratio break at the 200-day and then the S&P start to roll over? So that's kind of, if I had to guess right now on which way this will break, we were flirting with the 200, we're below the 50, we're consolidating right now after a breakdown. I would expect another breakdown here to come after this consolidation because we're not really breaking out here and taking off back above the 50. So until we do, there's a chance that we could break down. You can see the long-term PPO has been coming down. You can see bearish peaks on these oscillators here. So something to kind of keep an eye on here is, eventually this ratio is going to turn back to positive, which means the ratio and the S&P will start moving in the same direction again. And, which way? Will both of them start going, considering the S&P has gone up so much? An upward move on both of them wouldn't last very long because of how much the S&P is already bullish. Doesn't mean it can't go up. It just means it's going to be more limited in its upside there. We also kind of watch some of these other growth ratios like growth versus value. And you can see, it's kind of diverging with higher highs and lower highs in these oscillators. We're below moving averages here. So that's, we're still experiencing some weakness on that. Discretionary relative to staples, another important ratio that is still well above its 8-day moving average, 95% correlated with the S&P. So it's still very strong and still looking pretty good. XLK relative to energy is also an important one. Energy's had a great week this week, and you can see the ratio is broken below a bunch of moving averages this week, and it's strongly positively correlated. So a break towards the 200 on this ratio that would most likely mean that we are continuing the near-term decline and maybe a little bit more continuing it longer than we would feel comfortable with. There's the energy sector on its own. Here's the technology sector kind of slowing down. Had a good run off this September 2nd low, had a really, really good run. That's what fueled this near-term rally we've been on. But now it's had a really rough week. It's had not a bad week, but it's not, it's slowed down this week. And, the question is, are we, like, the momentum, the relative strength is pretty darn high, relatively speaking. That peak right there that you can see in the middle of the chart is high. And here's some context. You can see right now, like 101 is pretty high. It can go up to 102. So there's a little bit more, but you can see the momentum is also pretty high. And so it's going to start losing momentum. So that means the relative strength, if it keeps going up, will start slowing down, and we'll start to look something like this, where it's like, okay, it looks like we're coming off of a low below the average, and we get up, and then we just kind of start to slow down. We're still moving higher, but it eventually leads into some period of softness. So I think that's the scenario we're in right now. Like, we can still kind of grind up and get a near-term rally here. Probably won't be a big long one, and eventually, like that 5% decline on the zigzag, which won't be that big of a problem, but eventually that sucker's going to hit. And when it does, it won't, we'll be very grateful, because after you get a 5% red tag, you typically get a double-digit green tag. So it's going to be nice to get plus or minus a point or two, right? So it's going to be nice to get that 5% tag at some point, and the intermediate pullback, and coming down, but towards very strong support, and to move higher from there. That's coming, but I don't think it's coming next week, and I don't think it will be that big of a deal when it does come, because it will just give us, like this move here, a great double-digit gain after that, and then we'll see what ends up happening. But it'll give us a good move, which will be which we'll really take advantage of if and when it does come. Most likely by the end of the year. Most likely by the end of the year, we'll be well into whatever double-digit return we'll be getting off of that 5% decline. All right, now let's take a look at how the sectors move. And this is why, again, I don't think that we're done. If you look at, again, this is what we want to see. XOK, XLY, and XLC, you want those three sectors to be your best performing sectors. And that wasn't really necessarily the case today. If you take a look at, here, let's go 5 minute. If you take a look at this chart, XLY did good, but like materials rebounded from very oversold levels. Utilities were up and real estate were up, even though yields were not down. Like though they typically do very well when yields are down because they're interest rate sensitive. But yields were up today, and those two did very well. Healthcare is up there too, a safe haven sector. Of course, Staples down, struggling there with Costco earnings really weighing on Staples and its peers. And then you can see technology lagging behind. XLC rebounded late in the day, but XLK never did. So the XLK for the longest time was the only sector that was underperforming and negative. Eventually Staples eventually it went positive and Staples stayed below. But that's not, we don't want XLK to be an underperformer. So we don't want all of these sectors to be outperforming the S&P. We want them to be up, but below the black line, not above it. So that's not the chart. This is not the chart that suggests, okay, we're bouncing off of this low, which is why, again, I think we might probably have another day or two. Like if I zoom out to when this whole thing started, so it started, we had the up day on Monday, so the down period started on the 23rd. You can see energy's up 5% since the market rolled over, and utilities and real estate and Staples, even with Staples lagging on Friday, still was an outperformer compared to all these other cyclical areas like financials, industrials, materials, and healthcare and technology, discretionary, and communication services. So like they're all down on the week, and you have some of your the only ones that were up were your safety trades, safety sectors, and energy. So not a great week, and then like I said, I don't think, it's not, we see rotation like this. We've had lots of near-term declines on this current intermediate rally. This doesn't mean that that the end is near. The end is near, but it's just not imminent, right? It's not next week. I don't think this near-term decline's done, and I don't think this is the last near-term decline that will turn into the 5% pullback. I think there's still at least one, if not two, more near-term rallies left. They'll be shorter, but I think there's still a couple of near-term rallies left before we get the near-term decline that turns into something more, right? And again, like I said, a near-term decline, like I said before, a near-term decline that starts an intermediate decline looks like this over here, like in February, and this does not look like that. So I think we're okay still. All right, well, that brings us to our trade idea of the day. Let's take a look at Take-Two Interactive. So Electronic Arts really blew up big time yesterday, up to 193 after hitting a high of 197. New 52-week highs. You can see the market forecast really turning up in a nice way. This is a great pattern on the short-term pattern, but such a big move. So Take-Two obviously benefited in the same industry and has been trending higher already anyway. Also has a nice little rebound, crossing above we went from bearish territory to bullish territory on short-term sentiment. Momentum line is higher. We had a little bit of a near-term decline there this down day, but nice rebound up to new highs. We like that chart. If I look at the weekly chart for it, you can see that, we had a little bit of a transition candle, but clearly not a bearish candle. So you expect it to be a continuation transition instead of a reversal. So I like that setup. The PPO is rising. If I look at the 3 green arrow chart, I think we had 2 red arrows, and we still don't have the 3 greens yet. But the MACD is really close, nice bounce up, and you can see the stochastic is also very, very close. So very good chance we get the 3 greens on Monday, unless we have a significant drop off. If you look at the 2-line version of that chart, you're easily back above the 8-day moving and the 17-day for that matter, closing above both of them today. Like I said, getting up to new highs, closing above the value area as well. The MACD is still bullish. It's above 0, but it's not, not above its moving average yet, but close. Stochastic still in bullish territory too. If I look at the DMI for Take-Two, you can see a bullish crossover again after a brief bearish crossover. We're back to bullish, above 30 on the positive indicator, below 20 on the negative. If I look at the Ichimoku cloud, we still have a pretty good close to mature trend, right? So intermediate strength trend, very close to mature. You can see the clouds just barely turn green. We're above the green line. The rate of change is strongly positive. So that looks all really good. And then if I look at the Bollinger Bands and the Keltner channels, the bandwidth have been declining, and we're right up on top of that upper band, as well as, close to the upper Keltner channels. Well, the bands have just moved inside the Keltner channels with that decline to the midpoint, but a nice bounce off of that, and we're moving higher again. So what I decided to do here was to do a bullish trade for October expiration. The last time we can do a bullish trade for October. Now we'll flip to November on Monday. So this is our last October expiration trade. And you can see we'll sell the 30 delta. Usually we sell mid 30s, but we could, if I can get a good 30% return at the low 30s, we'll do it. And that's what ended up happening here. We sold the 30 delta, and we're getting, about a 40% return on risk. 30% is the minimum, but that's a really good return on risk there. And you can see where the break even is on the chart, and you put that onto the chart. Pretty much we'd have to reverse today's move and get back below these highs, and get back below pretty much yesterday's close for us to be like, and get into the lower half of the, we'd be bearish at that point. So that's where we want to be, right? If we're going to do a short put vertical spread, which is relatively high probability, 65%, then if we're going to break down and lose $400, we want to make sure that we don't lose $400, which is what we're trying to make on a whim, because we don't want to lose $1,000. So we want to be able to get out early, but we don't want to get out too early that we're just getting out on a whim, on a fluke, on movement, on noise. So clearly, by the time we lose $400, which is down in this range, then it would be a clear shift in sentiment, and it wouldn't be just noise at that point. Doesn't mean that won't happen, right? Because things can change. But we just want to make sure that if we take a small loss on a short vertical or an iron condor spread, it needs to be a significant change, a change from what we, in this case, from a bullish trade to now not bullish, or in the case of a neutral iron condor, that we're breaking out of the range. And that's typically what we look for there, and that's what we got here. All right, well, that does it for today. Today was our free Friday video, as I mentioned before. If you want access to videos like this every day, we do a 30-minute full video every day. I give a preview for it for free on YouTube. But if you want the full video every day, it's only hosted on our website. And you do have to subscribe. If you subscribe here for our foundation tier, it's just $29 a month. You can cancel at any time. You get the full version every day, so 5 days a week. The trade that you get, the trade every day. You also get access to our Market Outlook live video that we do at 3:30 Eastern time. It's a live stream where we put on the trade in real time, and then we manage all the existing trades in real time as well. And we talk about what we do, and then we get access to our live trade tracker, where we track the results of all of these trades that we do. Again, 5 times a week, 21 times a month, right? Again, all for just $29 a month. So you can kind of get an idea of how we do in those trades relative to what you're spending. A lot of times people use what they make. We've had subscribers tell us that they use what they make from our Market Outlook trades, and that helps cover the costs of the education for our premium services. For all of the, we have 10 trading rooms for all of our premium subscribers and elite subscribers from week to week. So there's the $29. It's well worth. And we wanted to make sure we gave everybody an opportunity to get started with us at a nice, good beginning tier, and that's what our foundation tier is. Again, that link that I shared with you earlier up there in the top right corner gets you there. Thank you for watching. Have a great rest of your weekend. Follow me on Twitter at DavidSettle42 for more content between the videos. Subscribe to our YouTube channel so you get the preview videos at the very least for free every day. Remember earlier, subscribe to our website for free to get the Market Outlook blog post every day. That also has a preview video on it. So at least you get that for free every day. And then we'll see everybody here on Monday. All right, goodbye, everybody.